Good morning. This is Kurt Spieler, Chief Investment Officer. Thank you for joining today. With me is Matt Vinkner, a Senior Portfolio Manager that's also going to be part of the presentation. Before we get started with the presentation that we prepared for you, I've gotten a number of questions over my 30-plus years in investment career around politics and what does it mean, and people ask me, well, how do you do, factor in all the various iterations? And my answer has been, well, I don't. Fortunately for me in my investment career, politics doesn't matter. Normally, I get a lot of disbelief with that, so I wish we could see all your faces and we were here in person as compared to virtually. But the reality is I followed up with, the average investor overstates the impact of the presidency and politics on the market. In essence, our message has been, vote your opinions, not your dollars. So with that, the first part of the presentation, even though I say it doesn't matter, of course, we're going to talk a little bit about politics and what it matters from that standpoint. If you look at our post-election thoughts, in January 2020, we started writing about it. We knew this was an issue on a lot of participants. Just talking a little bit about what we stated in January 2020, a historical analysis of the impact of political parties and the equity returns show the market moves up regardless of the various iterations. In fact, I have the exact numbers. I divided government, which it looks like we're going to have. Here, 60%, the S&P 500 goes up on average 60%. Democratic control of both the presidency and Congress, 56% is the returns. And then Republicans, it's 35% if they control both the presidencies and Congress. And I think our point is primarily as the market goes up, regardless, so that there are other factors that are more important. In July 2020, the last market update dated, we talked about 10 truths, no matter who wins. If you look at it, number 6, I thought was interesting. Predictions tend to be wrong. I think we have found that out with the expectation of a blue wave being incorrect. And then number 7, monetary policy matters more. So the most important person in Washington, as from an investment perspective, is Fed Chairman Jerome Powell from that perspective. In September, portfolio manager Andy Fromm wrote an election year blog. I think it's worth reiterating that advice. In an election year, how is it different than investing in a non-election year? And from our focus, it's the same. So stay invested, don't overact based on emotion, and stick to your long-term plan. Now, even though we say predictions tend to be wrong, we decided to have some fun this morning and talk about or give you a poll. So turning to the first poll, number 1, in 2021, will the economy grow 4% or more, B, grow 1 to 3%, C, stall 0%, so in excellent go flat, or D, dip back into the recession. We're going to give you a few seconds here to answer that question. Turning to Matt, why don't you start talking about the economy and the presentation that we prepared in terms of how it's going today.
Okay, thanks, Kurt. We do have quite a bit to talk about in the economy. It's been certainly an eventful year when you look at everything that we've been through with an election, with COVID, with the changes in the economy. And COVID has certainly been the biggest driver of economics this year. If you look at the chart here on the page, the first chart shows you the GDP number. The solid black line is the GDP fall off we saw in the first quarter and second quarter. First quarter wasn't too bad. We didn't really get impacted by COVID until the middle of March, but the second quarter is when most of us were locked down. And GDP fell about 34% in the second quarter. Now, third quarter, everybody was trying to get back into work. People started to become accustomed to what COVID was and how it would impact their lives, and so it bounced back very nicely. We had a 33% growth rate in Q3. We're getting back to where we were, but nominal GDP is still about 3.5% below where it was in the fourth quarter last year. So we still have a lot more growing to do. for a reference point, a 3.5% drop is about what the worst of the 2008 Great Recession was, believe it or not. So we've actually, the GDP drop was actually as violent as it was, worse than 2008. But because the economy was in good shape, the overall economic impact was not as bad. So the economy is improving. That's our main thought today. We are seeing lots of areas that are improving. Another area that's improving is manufacturing. This chart is looking at the global manufacturing activity. This is a chart where it's a survey that looked at manufacturers, and anything that's above 50 means that manufacturing is doing better than it was in prior months. Below 50 means it's doing worse. So you can see in previous recessions, we were down to 0 or 10. It looked pretty ugly back in March. But right now, at 80.8, that's a pretty good sign for manufacturing. And manufacturing is doing very well, mainly because you can socially distance in factories, you can do well in manufacturing, you can keep keep COVID away when you're in a factory, basically. So it helps to get a lot of this big part of our economy back on track. Another area, speaking of building, is home building. Home builders are having a great year. Number one, due to low interest rates. When interest rates are near 0, mortgage rates are below 3% in some cases, home builders are going to have a great year. Also due to the fact that you don't have a big supply of houses on the market right now. Not a lot of people are looking to sell a house. Some are, but as you look at the opportunity to sell a house in the COVID era, it becomes a little bit difficult. So for the home builders, and housing is a pretty substantial part of our economy, that's a good sign as well. Now, retail sales are another area that have actually been surprisingly good. We've all been spending despite being locked down. This chart is showing you online versus in-store retail sales. The purple line did very well in the beginning of the lockdown. That's the online sales. And the red line, which is brick and mortar sales, actually had a huge sell-off early in this COVID era, but snapped back very quickly once people felt more comfortable getting out a little bit. And now we're seeing retail sales pick up pretty nicely. So the consumer is doing okay, but we'd still always love to see this do a little better. Now, as we look at this part of the economy that's going well, let's take a look at the poll that we just had and see how everybody responded to this. And most of the participants here are pretty optimistic. Looks like we're going to see the economy grow 1 to 3% next year. And I think that's realistic. It could grow faster. It's going to depend a lot on COVID and how that progresses. But given the momentum we have in the economy now, as well as all the stimulus that we're seeing from the market, from the government and the Federal Reserve, I think a 1 to 3% growth rate next year is probably realistic. Now, it seems like all of you handled that poll question pretty well. So let's give you another one. If we transition to poll question number 2, this question is more about what's the biggest risk to the markets next year. We've talked about what's going well in the economy, but what's the biggest risk to the markets next year? Is it the economy, COVID? Is it going to be the deficits that we're running and the debt levels that we have, or is it valuations in the market? I'll give you a few seconds to answer that one. All right, so while you're all finishing answering that question, let's talk a little bit about some of those risks. There are definitely parts of the economy that are still struggling. This is a survey that was done of restaurants. When you have, obviously, restaurants that have been trying to stay open over the last few months, a lot of the ability to stay open has been due to having outdoor seating. Well, now we're going into winter, and that's not going to fare as well. And it's basically showing here restaurants, as soon as the temperatures drop into the 40s, outdoor seating is essentially done. You can make it happen in certain cases, but it becomes a lot tougher. So restaurants have really been hurting throughout this pandemic. Many restaurants have closed up, and many are still struggling to stay alive. So that's clearly one area of the economy that's struggling. A bigger part of the economy that's struggling has been oil. Obviously, as we've been locked down, there hasn't been as big of a demand for oil. We don't drive as many miles, we don't fly, we don't cruise. And so oil fell off dramatically, getting cut in half almost, or down by 2/3 almost in the early parts of the pandemic. It's come back. It's back above 40, and in fact, yesterday had a really good day. So things are improving for the energy markets, but as Kurt will talk about later, energy is really struggling. The energy companies are really struggling right now. And if the economy continues to improve, oil will improve as well, but it's a rough road for energy companies right now. The consumer overall, if we look on the next page, is doing okay. We still have many people out of work, roughly 5 million fewer people employed today than were employed in January. And so the consumer confidence has taken a hit relative to where we were in the beginning of the year, but it's stabilized. The initial fall off in consumer confidence back in March was triggered because nobody really knew how to handle COVID. What would it mean for their job? What would it mean for their lifestyle? Now people know how to handle it. They just need to know, when is this going to end? So the consumer is getting better, but that's going to be the big driver in the economy over the next couple of years. How comfortable will the consumer be in this COVID world? And part of that nervousness is around jobs. We lost quite a few jobs in April during the beginning of the lockdown. They came back quickly in May and June, and that pace has been getting better every month until recently. Now we've kind of hit a point where the job growth is slowing. We're still seeing more jobs come back, but it is slowing as we go into the future. So until we see a definitive end to COVID, job growth might be one area that causes the consumer more concern. Now, looking at the economy in the future, COVID is going to be a big impact. I'm not going to go into all the COVID data. We've talked about that in the past. I'm sure you hear that on the news every day. But nonetheless, we are in a upward trajectory as far as cases go right now, something that's going to probably hinder the economy a little bit in the next few months. But as you may have seen yesterday, vaccine is showing very good promise right now and could be out in the public as soon as early next year if all the testing continues to go as well as they think it does. So that's a very, very positive sign going forward. Now, another issue we're going to keep an eye on is the deficits and the bouncing debt levels we have in the U.S. This chart, it's a little confusing, but what it shows is the twin deficits that we have right now, both the trade deficit, which are the red bars, as well as the budget deficit, which is the black bars. And if you combine the two of those, we have the largest combined trade deficit in the world, or combined budget deficit in the world. So if you look at the $3 trillion deficit we ran in fiscal 2020, that's a pretty big chunk of money we spent that we had to borrow from other countries and from ourselves. So that is going to put some pressure on the dollar over time, and that is going to create some opportunities we'll talk about later. But that's one concern that I'm sure a lot of us have, is what does these massive deficits, as well as the ever-expanding debt levels, mean for our economy in the long term? It was certainly necessary to get through COVID, but the long-term impacts are the thing we need to think about over the next few years. So having addressed what's happening in the economy, let's take a look at the poll results and see how things look as far as what you think the biggest risks are. And looks like most of the people, 43%, thought COVID will be the biggest issue for the markets. 32% say the deficit, and about 12 or 13% say it's either the economy or valuations. So COVID is definitely the biggest concern, and we've seen that in the markets as well. COVID has, now that we've passed the election, COVID is certainly one of the biggest concerns on investors' minds. And in all honesty, we've seen over the last couple months how poorly poll questions can be written. In reality, I think it's a combination of all of these that are the biggest risks. COVID is certainly going to be the biggest driver of the economy over the next year. We've seen that just this year, a huge sell-off in March due to COVID starting, but also a huge increase in the market, a huge gain yesterday once we saw a vaccine. So I think COVID will be the instigator of big market moves in the future, but it's going to be how it impacts the economy that's really going to drive the market movements in the future. So you're all doing really well with the poll questions. We're going to give you one more to think about. The final poll question is asking you to pull out your crystal balls and let us know what the best asset class will be in 2021. What will be the best performing asset class? Will it be cash, bonds, stocks, or gold? And I'll give you a few seconds to answer that one. Well, there's a lot of different possibilities for this question, so I'll be interested to see what it looks like. But for now, I'm going to have Kurt pull out his crystal ball and talk a little bit about what the markets are doing and what might happen next year.
Thank you, Matt. Let's start with cash. Federal Reserve policy, and what this table shows is the Fed funds rate forecast, what the so-called dot plot, which is what the median Fed governor says. And as illustrated, for the next 3 years, interest rates are likely to remain at 0%. So the Fed has indicated they're not even thinking about raising interest rates, that they'd like to see the inflation at 2% or run even above 2% in the short term to get us back in the path. Long term, their expectations are for interest rates of 2.5% is the rate that the Fed funds rate will end up in a normal economic environment. So don't fear, even though cash is going to earn 0, it still could be the right answer. That's what you put down in your poll, because the rest of the asset classes could be negative. Second up, the fixed income market. This is the yield curves from a 3-month Treasury or short-term corporate paper to 10 years. The blue line is the U.S. Treasuries curve. So you can see starting at close to 0% on the 3-month and going to a little over 0.8%. It has come up since November 6th that this data was taken from, but we're still well shy of 1%. Municipal bonds is in the red line. This is not tax adjusted, so for high net worth clients, we do believe in municipal bonds if you adjust for the state and federal tax rates, but you can see interest rates are low across the board. For accounts that are invested in taxable strategies, we are finding some value in credit. This is very much high quality credit, AA type corporate bonds, and you can see in the green the yield curve from that, so going to a rate of around 1.5% on the 10-year. If you look at A paper, BBB paper, as well as below investment grade bonds, we would characterize the credit environment as close to average spreads on a historical basis. So our core fixed income manager has been increasing their allocation to corporate bonds, as well as certain types of asset-backed securities where there's been some relative value. That's fine. Within the satellite portion of our fixed income allocation, which today includes a short-term opportunistic credit as well as a small allocation to high yield, we have in the last few months increased allocation to that opportunistic credit fund. Turning to the stock market, a couple things. This is the S&P 1500 sector weightings as of January 1st from the 11 S&P sector weightings. The year-to-date returns through October 31st, so the last week in October, was relatively difficult with the market down, the opposite of what's occurred in the first 6 to 7 days here in November. But you can see the returns and then the sector weighting as of October 31st. So how much has that changed based on the huge discrepancy in returns? In general, the growth areas of the marketplace, which the biases are towards information technology, parts of healthcare, consumer discretionary, and communication services have done quite well. So there's been a huge discrepancy in the stock market returns, which is 1.8% through October 31st. Now it's up closer to 10% with the run in November, but has really favored those growthy areas of the marketplace. There's been a lot of discussion about, are we in a bubble from that standpoint within technology? You can see the weighting is 26.5%. A lot of discussion around the top 5 or top 6 stocks, the biggest companies in the world, that it's high. And the answer is that area of the marketplace is expensive, but also it's at basically similar weighting levels as back in the 1999-2000 period, the momentum bubble period that people are referring to. But its percentage share of company earnings, GDP has grown. So technology back 20 years ago was 7% of the economy, and today it's 17%. So although we're back to similar weightings in terms of the impact on the market and one particular sector, you also have seen a tremendous amount of growth in terms of the participation in the overall economy. Good news on the earnings front. So this is the S&P 500, the earnings surprises so far in the third quarter. 89% of companies have reported third quarter earnings. As you can see in the highlighted green area, 86% of those companies have beat earning estimates, and it's been very broad through all 11 economic sectors. This is one of the largest increases in terms of earnings surprises that we've seen. Second quarter was also, very positive from that standpoint. If you look at it, it's coming from cost cutting. So companies have responded to the COVID environment, focused on expenses. Productivity in the U.S. has grown by 4.1%. So not only are you seeing a reduction in expenses, but you've also experienced productivity gains. So people are working from home at a very high level. The other aspect is a lot of companies have pulled guidance over the last couple of quarters. And so I think Wall Street's been, pretty conservative. But to put it in perspective, at the end of September, the expectation for this quarter was a 21% earnings decline. And so far, we're trending towards about 8%. And so this is a significant difference, and it's part of the stock market performance has just been the fundamentals of companies. We believe that earnings is extremely important. This shows you the calendar year EPS. So the drop so far in 2020 expectations is for negative 17%, and that's the move from 2019 calendar year of 163.02 S&P EPS to 135. With the continuation of better than expected results in the third quarter and some increases of the guidance, a lot of analysts are now saying, somewhere around $140 earnings per share. Conversely, in 2021, you've seen some of that optimism come in. And so analysts as of a week ago, were expecting $167 of earnings per share, and now we're starting to see that trend towards the $165 level. We see this as extremely important, and to a certain extent, with the economy still 3.5% lower, how are earnings down somewhere this year, somewhere around 14%? Where's the operating leverage? I think a piece of that is the haves versus the have-nots, the economy that Matt was describing in terms of some sectors doing particularly well, and then the service-oriented, hotels, travel, leisure sectors doing, restaurants doing poorly. The sectors that are doing poorly have the tendency to be your lower margin, lower returns on capital businesses. So technology has high returns on capital and profitability. And then it's also that shift in weightings, that those traditional, maybe more value-oriented sectors are less a piece of the stock market today. So this is large cap companies as compared to the employment, which is more in the small businesses. And so overall, the earnings outlook is pretty good from that shift and just from how companies have been managing their businesses. Why we spend so much time on earnings if it's not, politics? It is to us what's driving the market is the economy and earnings. This chart shows the S&P 1500. Again, that's just large caps, mid caps, and small caps. So S&P 500 would be large caps from that standpoint, and shows the high correlation with the price in the black and the earnings per share forecast, so next 12 months, in the green. When we presented this chart in July, you had a huge gap there between the prices of the market had started to go up in the summer, but earnings had just started to show signs of recovery and increases in the forward earnings per share. What you've seen with September and October, the market being down, and just the increases, the earnings being much better in the second and third quarter, you've seen a better outlook. So you're in essence coming together. With the move in November, the market is approaching the top part of the spike, but you can see that earnings in essence are starting to catch up, that the market moved first. If we showed a longer history than the 5 years, it'd be a very tight correlation. We just wanted to emphasize the shorter term to show, the gap that the market's still a little bit ahead of earnings expectations, but they're catching up in a huge degree. Turning to one of the risks that we talked about or alluded to earlier, the valuations of the marketplace. So the current PE for the U.S. market ranges from 17.4 times, and this is on expected next 12 months earnings, to 20 times for the S&P 500. You can see the international developed, international emerging markets. So the market is still expensive. Historically, you can see the PE premiums to the 15-year average from that perspective. We use valuations along with our economic outlook, the earnings outlook that we see to make some decisions on a tactical basis. To date, we have been overweight U.S. Large caps. That's been the best performing area of the marketplace. Slightly underweight U.S. small and mid cap, and underweight international as part of this. No changes here recently to those tactical asset allocations, although U.S. small caps and mid caps are looking interesting again to us. So a lot of earnings recovery is expected if the economy continues to grow. As we maybe get more confirmation in terms of the outlook, and assuming that you still have those attractive areas on a relative basis from a valuation basis, that is an interesting part of the area. We haven't talked much about value versus growth, except for to state that growth's done so much better. We believe strongly in diversification, so we've had a slight bias towards growth. That's another area that could do better if interest rates start to increase. Not only do your economically sensitive areas of international and U.S. Small and mid cap, but also, do you want to add allocation to value? So there are opportunities to add value, even though overall we would say the stock market remains somewhat expensive relative to its history. Relative to bonds, we've talked about how low interest rates are and, the valuations of the stock market. This is the equity risk premium, so it compares the 10-year Treasury to the valuations of the 1500 on a earnings to price, the inverse of the price to earnings ratio. You can see this over the last 15 years. We've had times where bonds are inexpensive or stocks are inexpensive. Today, we would say that, in essence, stocks are fairly valued based on the level of the interest rates. So not a lot of opportunities from a tactical shift that the market is priced somewhat similar, I guess, to where it should be as compared to the fixed income market. In terms of what we're doing within our portfolios, and similar to prior presentations, if you've participated with us, we pick out a moderate objective. We certainly work with clients that are all fixed income as well as all equities. So this is where that financial planning, the long-term asset allocation plays into the decision. Why we're using the moderate portfolio as an example is it is widely used with our clients, but it also allows us to look at where do we stand within equities, fixed income, alternatives, and cash. So it allows you to show some of those tactical decisions, what we like today, what we don't like. So the range is stated, so equities 40 to 70% for this investment objective. The target or midpoint is 55%, and then we've, for your benefit, have put in what are the, where were we a year ago, 58% in equities, and where were we as of a week ago or 10 days ago, 55.5%. So if you look at it in terms of what we've been doing, it's been more maintaining the stock allocation through the downturn in COVID-19. We did some rebalancing in the August period, but equities in general have been in that 55 to 57% over the last quarter or last 4 or 5 months from that perspective. We've continued to have a lower allocation than the target in fixed income. As I've mentioned, we have made some changes to the satellite portion of the portfolio. The biggest change, though, from a year ago is the, in essence, doubling of the alternatives exposure of 5% to 9.8% for clients invested in the moderate portfolio. So a little bit of this, or most of this has come, some of this has come from cash, some of this has come from the equity allocation. We use mutual funds and ETFs for this exposure. The hedged equity mutual fund is something that we added in July 2019 and has done exactly what we were looking for, that it does provide some participation. The 3-year beta, what that means is if the stock market is up 10%, we would expect this with a beta of 0.37% to be up 3.7%. And if the market's down 10%, the reverse would be true. You'd expect the fund, in this case, to be down 3.7%. What we've experienced is better results than that. So they employ or provide participation in U.S. large cap stocks and then employ a disciplined option strategy to reduce downside risk. And so what we've experienced with this is when the market is down, their participation in the market is less, and when the market has rallied, the participation of the fund is greater. So just what you'd hope for, that it holds its value better, and did so in the February, March timeframe, but it's had higher levels of participation when the market's rebounding in April through November. The fund actually, as of yesterday, is up 11.69%. So it's been very much a value-added contribution. We added exposure to the fund in March, and then we also added some additional exposure in August. The latest one is gold, or an exchange-traded fund. We see that today as more of a tactical allocation. It's a viable alternative to cash, which is earning 0% today, and we see it as a potential benefit against continued sovereign financial concerns with governments running massive deficits. So if we continue to see the amount of spending occurring, people are going to look to other alternatives as governments are not valuing their own currency, including our government valuing the U.S. dollar. It also is a potential hedge against inflation and U.S. dollar weakness if the global economy starts recovery. So this is more of a tactical call. The reason for that is on the next chart. Although you can see gold versus the long-term price charts of equities, periods of times where gold has done well and the stock has not, which is the 70s in essence, and then a long bear market for gold when the stock market did well in the 80s and 90s. And so you can see as the chart goes through the last 50 years, various time frames. So from our perspective, as long as interest rates are zero, we see gold as an option relative and part of how we've brought down the cash levels from 4% to 2%, from that standpoint. So it's to us, it's maybe less attractive if you start to earn money in cash because gold is somewhat unique and it doesn't pay a dividend or interest from that perspective. But we see it for the next year or two as a positive addition to the portfolio. Well, let's go through the long awaited poll results here. Poll number 3 here to see how the participants are optimistic or pessimistic. So that's interesting. Stocks results 74%, bonds 12%, gold 8%, and cash at 3%. That's in line with our expectations, and so we are a believer that the economy will continue to grow, and earnings outlook, I think, is positive, as we've indicated, although valuations are high and there'll be some choppiness, along the way, as there always is in terms of volatility in the market. We believe it is the best positioned asset class for performance over the next year. In terms of the, some of our concerns and reasons for optimism and, as always, risks, we've covered a lot of these. So optimism, the recovery, human ingenuity, it's how companies manage their businesses, the vaccine work that is very promising, unprecedented in terms of how quickly we may have a vaccine with efficacy. The Federal Reserve support is going to continue. As we mentioned, they're buying about $120 billion in bonds, primarily treasuries, mortgage-backed securities, a little bit of corporate bonds, and they've continued to support the fixed income market, not just with interest rates at 0%, but with their quantitative easing or buying program. We'll be back into the potential for economic stimulus. The negotiations between the White House and Democrats broke down before elections, but they are restating. There's likely some more limited support coming, and so that should be supportive for the economy. The financial system is in much better shape, so unlike the financial crisis of 11 to 12 years ago. A lot of concerns, though, in the marketplace, how consumer behavior has changed, delays in the vaccine, valuations, the government deficit and the long-term impact and debt, and then, as always, geopolitical risk. So with that, I have to flip through here for you the index definitions and the disclosures from This Is the Opinions of myself and Matt and the rest of the investment team. We'd like to spend some time with your Q&A session here. So let's, switch to that.
And while questions are coming in, I talked briefly about the debt and the deficits, and how the deficit's been very important here in the last year in contributing to the stability of the economy, but it's creating a bunch of debt piling up on the government's books. What is the long-term impact, do you think, that we're going to be looking at?
Yeah, that's clearly from the polls and the questions we've gotten on one-on-one meetings. I think this is the time frame to run a deficit. So it is when the recession, when, we're down 3.5%, unemployment, close to 7%, 5 million less jobs in the economy. So stimulus is currently appropriate, but it does raise the concern on when times are better, how do you get your deficit under control? We don't see an immediate risk from the deficits or the debt levels. The U.S. economy has less debt as a percentage of the economy than many of the other developed nations in the world, so primarily Japan, Europe, China, though not developed yet, still has significant amount of debt. So we have room to continue to run deficits. What it means for the long term, however, I view it as kind of passing the buck to the next generation, that we're overspending our levels, and long term, what it means historically for some of those countries that have higher levels of debt is less growth. So more of the economy will go to repay interest from that standpoint instead of productive uses of the government situation. So if we looked at it in terms of a crisis coming, we didn't see it for 15 to 20 years, but the more we run trillion-dollar deficits, that time frame comes up when debt becomes a big deal is less. So it's likely no longer 15 to 20 years when it becomes a significant issue to the economy. What it is depends on, do we start to run less than trillion-dollar deficits? So I would characterize it as a long-term risk. It's something I'm worried about in terms of passing on and being to future generations, because they're going to be the ones that's going to have to pay for it, from that standpoint. But it's not an immediate short-term risk that would create a recession.
One asset class we didn't really talk about is real estate. And obviously the COVID world is changing people's thoughts on commercial real estate in particular. What are your thoughts on the outlook for real estate and commercial specifically and real estate in general?
Yeah, I would say, and we didn't show this today, but we do believe in a long-term allocation to real estate. We use a global real estate fund. Currently, we're 1.5% underweight. So the long-term exposure would be 4%, and we're at 2.5%, although you do get some exposure through some of our individual stock managers or mutual funds. So it's a little bit higher than that if you include the individual stock managers. So overall, we would have a bias against it from that standpoint. I'd say it's a little bit more industry specific. So office, there's a lot of companies evaluating as part of their cost cutting, how many people are going to work from home? Do we need less office space? Retail, consumption has changed and perhaps accelerated with the online buy-in. So it's going to be difficult if you're the owner of retail, whether it's malls, which are under a lot of pressure, or even some of the shopping centers. There's other areas that are doing better, apartments or multifamily, industrial areas, which are our beneficiaries. So as we get online deliveries, they come from warehouses. So there is parts of that sector that's doing well from a fundamental standpoint. But in general or in aggregate, it's not been, a very great area from an overall fundamental standpoint. The other reason why it's not a huge exposure in our portfolios today is interest rates over time are likely to ebb higher, and REITs or real estate are, leveraged compared to other sectors, and so they may see some pressure from rising interest rates. So to us, it's kind of a combination of mixed fundamentals and the potential that over time interest rates will go up, which will, negatively impact REITs or real estate investment trusts.
Well, real estate obviously is affected by interest rates, and with interest rates below 1% right now for a 10-year treasury, for example, bonds aren't particularly attractive as a holding right now. So they're rock solid as far as maintaining principal in general. But how might our thoughts on bonds shift over the next year, depending on where interest rates go?
Yeah, as we indicated earlier, we think bonds do provide a place in the portfolio, especially for clients in retirement or living off the income, so they still have the ability to produce income levels. So they have a role in the portfolio, but it's our bias has been for a few years because of the low interest rate environment to be not at that target or midpoint level. And so I don't see that changing. You'd have to have interest rates come up quite a bit. So from our perspective, it's how do we protect portfolios but also earn a little bit of additional income. Our emphasis is credit, and so there is some opportunities on a value basis, as I indicated. So we continue to look at what's the allocation to corporate bonds, primarily high-quality investment grade, but also below investment grade bonds. And so there's an evaluation that we're consistently doing within the fixed income committee in terms of how much exposure do we want. And so I can see over the next year we're not going to be looking to take interest rate risk, and so maintaining exposure to areas of the marketplace that has less risk to rising rates, and then how do you earn some additional income is through that emphasis on credit. So it's more of what we have been doing, and I would say over the next year, if anything, there'll be more of what we have been doing.
Now, there's a few questions in regards to politics and how they might impact the market going forward. And I think you addressed that pretty well at the beginning of the call. So I'm going to dance a little bit here and maybe consolidate a couple questions. What do you think the overall impact of the election, assuming it ends up being Biden-Harris along with a split Congress, do you think we should really pay attention to, or do you think we'll see any big swings as a result of that? A lot of concern might be about higher regulation or higher taxes, higher debt levels. Do you think we should have a big concern in portfolios about that?
Yeah, and to be clear, politics does create noise and does impact the market over the short term. What history would say is that short term, so that you revert back to what are the economic fundamentals, what are the company fundamentals, what are the valuations. So it's not that the market completely ignores it. In fact, I would say over the last week, what the market is saying is under the assumptions that Matt outlined, that this is the best case scenario. And in fact, since 1944, the best market returns have been a Democratic president with a split Congress. So markets liked it from that perspective. Why? If you believe the market pundits, maybe less chaos if it is Biden as the president, which is obviously extremely likely from that standpoint. But you don't have the ability to implement much of the progressive program, which could have a negative impact in terms of the economy. So taxes was one of the questions. Not going to happen as long as the Senate remains under Republican control from that standpoint. Regulation could increase somewhat, but we've been through that in other eras, and that's to us not a long-term market-moving event from that situation. So I think from here, the markets liked the results in the first week, but once again, it's going to return back to what's, is the economy growing 3 or 4% next year? If it is at the margin, some rollbacks, which is being discussed on the regulation, climate change, et cetera, that's not market or economic moving events. So when we talk about politics, we look at it and say policy can matter if it impacts the economy. And so our evaluation of what's going on political is what changes are being made and, not being talked about, but actually become policy, in implementation. We evaluate it just to determine should we be looking at that 3 to 4% growth rate and making adjustments. Right now, it doesn't look like those changes that are being proposed will be economic moving events, and the market's going to focus on other things than what's going on in Washington, D.C., in our opinion.
As a quick follow-up to that, it appears it's going to be a split Congress. There's an outside chance that both Georgia senators lose their runoff. It could be actually have a slight majority, Democrat majority in Congress or in the Senate. If that happens, there could be some shifts in policy, some faster shifts in policy that we'd have to evaluate at that particular time. But
I would say so, but I think that's pretty unlikely because there are still moderate Democrats and there are still moderate Republicans, maybe not as many in either party as they used to be. So a 50% majority, we don't see that, significantly higher taxes, the Green Deal, et cetera. So, even if in the unlikely event that the Georgia Senate runoff changes, you're not anywhere near the majority you need to get at least some of those policies implemented.
Yeah, the real questions and some of the questions in regards to politics really have been focusing around, tax policy, regulatory policy. But one question we'd be curious to see if you have an opinion on is around the trade deficit. And if we have an improved trade arrangements with various countries, could that help the economy, and what sectors might benefit from that?
The answer is yes. A lower trade deficit would improve. If you look at our trade deficits over the last few decades, though, it typically improves when we're in a recession and the rest of the economy globally is doing better. And so typically when we're recovering, because we are a consumption-oriented economy, we in essence, deficits rise when our economy is doing well from that standpoint. So I'm not sure it's likely, even if there is some rejoining, from a trade perspective, less conflict, less tariffs. That would be good for the U.S. economy, but also likely would benefit, other economies. In terms of sectors, it's pretty widespread in terms of, who benefits from that, from, consumer staples with some of our global food and beverage companies. Industrial companies, have quite a bit of international sales. Technology companies, also benefit, as a lot of those companies have, like an Apple, have significant amount of overseas sales as a part. So I wouldn't say that there's a theme, on, kind of an improving trade deficit, except for, your large multinational companies would perhaps, do better in that environment just because of their exposure to Europe and Asia as a piece of it. I think it would certainly be a positive, but maybe not as likely as long as our economy is doing well from that perspective, because, 2/3 of our economy is consumers, and some of those consumption items are imported items. Some of them are made here locally. So I think a lot of changes will be going on, a lot of talk about supply chains and supply chain disruption and changing, healthcare in particular in terms of that. So some of those, jobs or companies and governments are clearly rethinking the supply chain.
One question that's coming through is having to do with cash. Got a client who's got some CDs maturing soon and wondering if this would be a good time to invest in stocks, or would you be concerned about valuations and risk here?
Yeah, I think to me that answer is, what are you looking to accomplish with that cash? We believe people should set aside a rainy day fund for events like earlier this year that we went through, to have 6 to 12 months, whatever you're comfortable with, living expenses. If you're looking to invest and that time horizon is greater than 5 years, then my answer is yes, get fully invested in the appropriate asset allocation for you. We typically average into the market, so a lot of people are concerned, great market, we're 1% from our highs today. From that standpoint, I don't want to buy at the peak. So we do typically advise with cash, and whether it's CD maturities or other cash events, average in the market so we can take advantage of any volatility that might be forthcoming over the next, few months, from that standpoint. So, if it's long-term money, it's get invested and stay invested would be our advice with the appropriate long-term asset allocation.
Well, I think that's a great final question. We're coming right up on an hour now, so I think we're going to wrap it up here. If there's any questions that you still have, feel free to send them through your advisors. And if there's any that we didn't get to, we'll follow up with you individually. But thank you all for attending this Outlook and our update here. And we look forward to seeing you in the future. Any closing thoughts, Kurt?
No, I think we covered everything. Thank you for your participation in the polls. Hopefully you enjoyed that addition to our market updates, and have a great day. Thank you.